John, many thanks for your time. Just talking about this, of course, borrowers, we saw them react immediately, the big banks in particular. But how have you been seeing over a period of time the borrowers? How have they been sort of, if you like, anticipating this move by the Reserve Bank?
Yeah, and I think, look, nobody would be surprised by the move. I think more people were surprised by the timing of the move, so close to the electoral cycle. But if you look at, I think, the magnitude of the growth and the rate of growth in the underlying inflation rate, then it's not surprising the RBA did move as quickly.
Okay, I've been watching the stats also, and I just want your experience of this, because the proportion of fixed rate loans that I've seen over the past 12 months has grown exponentially compared with what it normally is. Normally down about 10%. Last number I saw, I think, was at 47, 48% of new borrowers were taking out fixed rate loans. Is that indicative, do you think, of those borrowers trying to protect themselves?
Yeah, and typically what you find is that people are endeavouring to pick the top or the bottom of the market, and by the time they pick it, it's come or it's gone. And so the peak for fixed rates in terms of take-up was probably about 9 or 10 months ago now, where you could get a 2-year fixed rate loan for something in the order, a 2-year fixed rate loan for something in the order of 1.99%. If you look at fixed rates now, then they're very firmly priced in an expectation of the cost of money over the next 3 to 5 years.
So what are you talking about there for the fixed rate loans for the 2 and 3 years at the moment? What are the best of those?
You're probably looking at somewhere in the early 3s to mid 3s. And then if you look at the underlying cost of money in the markets, then the expectation is that that's where it sits over this period, over this next 2 to 3 year period.
One of the things for your customers, though, is those who have taken out that 2 and 3 year fixed rate loans, they're likely to finish with those low rate loans just as interest rates are peaking in 18 months to 2 years' time. So, of course, they're going to also have to adjust to higher cost of borrowings down the track, aren't they?
Yeah, absolutely. And I think that what we've got within Australia is most lenders have done a good job in building in some sort of buffer in anticipation of rate increases. So if you look at the increase that we've had over this last 24, 48-hour period, then that's going to be something in the order of maybe $100 per month for an average Australian mortgage holder of $500,000. That in itself isn't significant. 1% is an additional $400. 3% is something in the order of $1,200 a month. And so if you drop that on people straight away, it would be a significant shock. It would be a significant adjustment. But the question is that in the assessment process, have the lenders made provision for that? And what you'll find is that lenders do exactly that. We certainly do that at Wave Money. We want people to be in a position whereby, these sorts of things will happen, and you can see it. It's in the tea leaves. You can see it in the forward cash prices. So why not anticipate that and make sure that nobody gets an unpleasant shock in the future? And we encourage people actually in this low rate environment, we always have, is to accelerate your repayments. You may have your loan over a longer term. Well, why not make repayments as if the interest rate was already at 3.5% or maybe even 4% and build a buffer.
And just quickly, it wouldn't be death by 1,000 cuts. It'd be death by almost 1,000 increases in that case. But just very quickly, because I've only got 30 seconds, tell me how competition affects the market. We know it's white hot, that competition, and every one of the lenders will cut each other up with rates. Is that going to actually keep a lid on the rate rises, or is it simply the cost of money's higher for them? They've got to pass it on.
Yeah, we once had the highest real interest rates in the world in Australia before the deregulation of banking and the rise in the non-bank lenders such as Wave Money. So competition compresses margins, it keeps people sharp, and it delivers great outcomes for consumers.
John Flavell from Wave Money, thanks for your time today on the program. So there you go.